What's up, everyone? And today we're diving deep into a topic that could save you a ton of money and stress: the most common investment mistakes. Look, I get it. Investing can seem complicated, but it doesn't have to be. The thing is, there are some really common pitfalls that trip people up and cost them big time in the long run. We're talking about the kind of mistakes that can take years to recover from, but the good news is they're totally avoidable. In this video, I'm breaking down 8 of the biggest investment mistakes people make, so you can sidestep them and set yourself up for success. So buckle up, grab your notebooks, and let's get started. All right, let's be real for a second. How many of us actually have a written financial plan? Not just a vague idea in your head, but something you've actually put down on paper or typed out. If you're like most people, you probably haven't, and honestly, you're not alone. But here's the thing, when it comes to investing, not having a plan is like trying to build a house without blueprints. You might have a vision, but you're missing the step-by-step guide that gets you there. Think about it. Would you ever set sail on the open sea without a map, a compass, or even a destination in mind? Probably not. Yet, so many people dive into investing with no clear direction, just hoping things will work out. It might sound adventurous, but in reality, it's a recipe for confusion and disappointment. Sure, you might end up somewhere eventually, but chances are it won't be where you actually want to be. You could find yourself lost, frustrated, or even worse, back at square one, wondering where things went wrong. So before you even think about buying a single stock, mutual fund, or crypto coin, take a step back. Ask yourself, what are you really trying to achieve? Are you looking to build wealth for the long term, or are you hoping for a quick win? Defining your goals is the first and most important step. Maybe you're saving for retirement, and you want to make sure you have enough to live comfortably when the time comes. Or perhaps you're planning for your kids' education, a big vacation, or just some financial security for peace of mind. It could be a down payment on your first home, that dream car you've always wanted, or even starting your own business. Whatever it is, get specific. The clearer your goals, the easier it is to create a plan that actually works for you. Once you know what you're working towards, figure out your timeline. Are you hoping to reach your goal in 5 years, 10 years, or even longer? Setting a realistic time frame helps you break your big dreams into smaller, manageable milestones, so you can track your progress along the way. Next up, let's talk about risk tolerance. This is a huge part of your investment plan, and it's different for everyone. Some people can handle big swings in the market without breaking a sweat, while others lose sleep over every little dip. Ask yourself, how much volatility can you really stomach? If your investments drop in value, will you panic and sell, or will you stay calm and stick to your plan? Understanding your comfort level with risk will help you avoid making emotional decisions that could hurt you in the long run. Are you okay with the idea that your investments might lose value in the short term if it means you could see bigger gains down the road? Or do you prefer a more stable, predictable path, even if the returns are a bit lower? There's no right or wrong answer, just what's right for you. Your risk tolerance will play a huge role in shaping your investment strategy. It determines whether you lean towards stocks, bonds, real estate, or something else entirely. And if you're not sure where you stand, talking to a financial advisor can help you figure it out. Once you've got your plan in place, your goals, your timeline, and your risk tolerance, stick to it. Consistency is key. It's easy to get distracted or second-guess yourself, especially when the market gets rocky. Don't let every hot stock tip or scary headline throw you off course. Remember, investing is a long game. Stay focused on your plan. Keep your eyes on your goals, and don't just wing it, because your financial future deserves more than guesswork. Let's be honest, we've all been tempted by the allure of quick riches. The idea of making a fortune overnight, of suddenly having all your financial worries disappear, is incredibly appealing. It's human nature to dream about hitting the jackpot, or stumbling upon the next big thing that will change your life in an instant. We see stories in the news about people who made millions from a single investment. And it's easy to imagine ourselves in their shoes. You see some cryptocurrency or meme stock skyrocketing and think, if I had just gotten in earlier, that could have been me. The fear of missing out is real, and it can push us to make impulsive decisions. Every day, there are headlines about people who turned a small amount of money into a fortune almost overnight. It feels like everyone else is getting rich except you, and that pressure can be overwhelming. But here's the truth. Chasing those quick gains is like playing the lottery. The odds are stacked against you, and for every story of someone who wins big, there are countless others who lose. The excitement of the gamble can be thrilling, but it's rarely a sustainable way to build wealth. Sure, a few lucky people win big, but the vast majority end up losing money. The reality is that most people who chase quick riches end up disappointed, and sometimes even worse off than when they started. The emotional roller coaster of big wins and bigger losses can take a toll on your mental and financial health. Remember, investing is a marathon, not a sprint. Just like training for a long-distance race, building wealth takes time, patience, and discipline. There are no shortcuts to lasting success. The most successful investors are those who stay the course, even when the journey feels slow or the market gets tough. Sustainable wealth is built over time through consistent contributions and smart decisions, not overnight gambles. By regularly investing even small amounts and making thoughtful choices, you give your money the chance to grow and compound. This approach may not make headlines, but it creates real, lasting financial security. Don't fall for the hype. The world is full of promises that sound too good to be true, and most of them are. It's easy to get distracted by bold claims and flashy advertisements, but remember that real wealth is rarely built on shortcuts. Instead, focus on building a diversified portfolio with solid companies that have a track record of growth. Diversification helps protect you from the ups and downs of any single investment, and choosing companies with proven histories increases your chances of long-term success. Take the time to learn about your investments and make informed decisions. It's not as glamorous as striking it rich quickly, but it's a much more reliable path to financial success. Over time, you'll find that the slow and steady approach not only grows your wealth, but also gives you peace of mind and confidence in your financial future. Remember, the real winners are those who stay patient, stay disciplined, and let time work its magic. You know the drill? Everyone's talking about this hot new stock or investment strategy, and you feel like you're missing out if you don't jump on the bandwagon. But here's the thing. Just because everyone else is doing something doesn't mean it's the right move, especially in investing. Remember the dot-com bubble? Everyone piled into tech stocks, and then the whole thing came crashing down. Blindly following the crowd can be disastrous for your portfolio. Instead of relying on the wisdom of the crowd, do your own research. Understand what you're investing in and why. Don't let FOMO or fear of missing out drive your investment decisions. We've all been there. You're watching the market, and suddenly it takes a sharp dip. Your heart starts racing, your palms get sweaty, and you feel that urge to do something, anything, to stop the losses. It's a natural reaction. After all, nobody likes to see their hard-earned money seemingly vanish in a matter of hours or days. You see your portfolio value dropping, and honestly, your first instinct might be to sell everything before it all disappears. That fear of losing more can be overwhelming, and it's easy to convince yourself that acting fast is the smart move. But it works the other way too. When the market's on fire and stocks are soaring, it's tempting to jump in head first, buying up whatever's hot just because everyone else seems to be making money. The excitement is contagious, and you don't want to miss out. The problem is, our emotions, whether it's fear, excitement, or even greed, can be terrible financial advisors. They push us to make snap decisions that often go against our long-term interests. When we let fear or greed dictate our investment decisions, we often end up buying high and selling low, which is, well, the exact opposite of what you want to do. This emotional roller coaster can lead to regret, missed opportunities, and even bigger losses over time. Instead of reacting emotionally, it's crucial to stick to your plan. Take a step back, breathe, and remember why you invested in the first place. A well-thought-out investment strategy is designed to weather the ups and downs of the market. Remind yourself of your investment goals and your personal risk tolerance. Are you investing for retirement, a home, or your child's education? Keeping your eyes on the bigger picture can help you avoid making rash decisions in the heat of the moment. If the market takes a downturn, don't panic. It's normal to feel uneasy, but remember that downturns are a part of the investing journey. Often, the worst thing you can do is react impulsively to short-term noise. Ride it out and remember that market fluctuations are normal. Over time, markets have historically recovered and grown. By staying calm and disciplined, you give yourself the best chance to achieve your financial goals. Imagine putting all your money into a single stock, no matter how promising it seems. What happens if that company goes bankrupt or their industry takes a hit? You guessed it, you lose everything. That's why diversification is so crucial. It's all about spreading your risk across different asset classes like stocks, bonds, real estate, and even alternative investments. Think of it like this. If one investment in your portfolio isn't doing so well, others can help to offset those losses. Diversification helps to cushion your portfolio from market volatility and reduces your overall risk. We all wish we could buy low and sell high, perfectly timing the market to maximize our returns. But here's the catch. It's practically impossible to consistently predict market movements. Even professional investors with years of experience and access to sophisticated tools struggle to time the market accurately. Trying to do it yourself is a recipe for stress and, most likely, lower returns. Instead of trying to outsmart the market, focus on what you can control: your savings rate, your investment strategy, and your long-term goals. Remember, time in the market is more important than timing the market. In the age of social media, everyone's suddenly a financial expert. But just because someone on YouTube or Twitter tells you to buy a particular stock doesn't mean it's a good idea. Relying on hearsay or blindly following investment advice without doing your own research is incredibly risky. Remember, it's your hard-earned money on the line. Before investing in anything, take the time to understand what you're buying. Read company financial statements, research their management team, and analyze their competitive landscape. Knowledge is power, especially when it comes to your finances. Investing is a long game. It's not about getting rich quick. It's about building wealth steadily over time. One of the biggest mistakes people make is constantly changing their portfolio or selling investments out of impatience. Remember the power of compounding? The longer you stay invested, the more your money has the potential to grow exponentially. Every time you sell an investment, you're not only potentially realizing a loss, but you're also resetting the compounding clock. Stay focused on your long-term goals and don't let short-term market fluctuations derail your progress. Remember, patience is a virtue, especially when it comes to investing. So there you have it, 8 common investment mistakes to avoid like the plague. Look, I know it can seem overwhelming, but the key takeaway here is that investing doesn't have to be complicated. By understanding these common pitfalls and taking a disciplined approach, you can set yourself up for financial success. Remember, building wealth takes time, patience, and a solid strategy. Don't let these mistakes derail your financial goals. Do your research, make informed decisions, and stay focused on the long term. And hey, if you found this video helpful, hit that like button and subscribe to my channel for more personal finance tips and tricks. Thanks for watching.